Okay, so it's 2026, and if you're running a business, I bet you're staring down a huge challenge, right? How in the world do you plan for growth when the economy feels like, well, like it's built on quicksand? It's the question on every owner's mind, and today we're going to build the playbook to answer it.
This quote from Huntington Bank's latest outlook it really nails the problem. All the old rules for planning, for investing, for growing your business, let's be honest, they just don't apply anymore. We are in a totally new landscape, one that demands we be way more agile and way more forward-thinking.
That's the question, isn't it? It's probably what keeps you up at night. But here's the good news. You don't have to figure this out alone. In this explainer, we are laying out a clear, step-by-step framework for making the right moves right now.
First things first, before we can make any move, we have to understand the game board. So our first step is to piece together this 2026 economic puzzle. What are the big forces at play that you absolutely need to be aware of?
Scott Kleinman from Huntington Commercial Bank, he doesn't mince words here. We're in a uniquely uncertain and, volatile time. This is not business as usual, not by a long shot. It's all about navigating this complexity with some real confidence.
Now here's where it gets really interesting. Let's break down what uncertainty actually means, because the economy isn't just shaky, it's divided. Take a look at this data from Huntington Bank. Households making over 150 grand a year, they're actually increasing their spending and by a lot. But on the other side, folks at the lower end are pulling back. What does that do? It creates this lopsided market where demand isn't universal. It's super concentrated. So you put it all together, and you're not just dealing with one little headwind. You're sailing into a bit of a perfect storm. You've got divided customers, interest rates that are all over the place, a super tight labor market, and inflation that just won't quit. These are the waves you've got to navigate to find any growth in 2026.
Okay, so that's the landscape. A little daunting, I know. But now let's talk strategy. How do you actually grow in an environment like this? Well, the answer lies in something called smart financing, and using it to sidestep a trap that catches even the most experienced business owners.
So here's the dilemma, and you've probably felt this. You can see the path to growth. It's that new machine, that upgraded piece of tech. It's the one thing standing between you and taking on bigger, better jobs. And your first instinct might be to just pay cash for it, right? Get it over with. But in this economy, dumping all your liquid cash into a single purchase is an incredibly risky move. And this, my friends, is what's known as the growth trap. You've invested in the potential for growth, but you've lost the flexibility to actually seize it. So when a huge, unexpected opportunity comes along, one that needs cash up front, your hands are completely tied. Your operations just grind to a halt.
This is why we need to completely reframe how we think about this. Financing isn't just about taking on debt. It's a strategic tool. It's what lets you keep your cash free for the important stuff. Payroll, inventory, and those game-changing opportunities that pop up out of nowhere. It lets you get the tools you need now while protecting your financial agility.
Okay, so once you decide to finance, you immediately hit a major fork in the road. And it's a huge choice between two very different paths. It really all boils down to a classic trade-off: ownership versus flexibility. So what's your move going to be? Are you going for a loan, or are you going to sign a lease? I know they might sound kind of similar, but trust me, they affect your business, your balance sheet, and your cash flow in completely different ways.
Let's just break it down nice and simple. With a loan, you own it. Boom. It's your asset from day one. But you'll almost certainly need a down payment. With a lease, the financing company keeps ownership. The huge upside there? Little to no money down, and a much, much faster approval process. It's a straight-up choice between control and preserving your cash.
So, let's say you're leaning toward ownership. You want that asset on your books. Great, but even then, you've still got options to sort through. So let's explore the most common types of loans you're going to run into. First up, the old classic, a traditional bank loan. This is what most people think of. The big pro? You'll probably get a really competitive interest rate. But the cons? Well, they can be a deal breaker. Banks are super strict, the process can drag on for weeks, and they'll probably ask you to put up other business assets as collateral. Now, here's a really popular alternative, a dedicated equipment financing loan. The genius of this is that the equipment you're buying is the collateral. What does that mean for you? It means your other business assets, and even your personal stuff, are safe. The flip side is pretty straightforward. If you stop making payments, they come and take that specific piece of equipment.
And finally, there's vendor financing. This is when the company that's selling you the equipment also offers to finance it. Think of it like a one-stop shop. The biggest advantage here is just pure convenience. But you have to be careful. You might end up paying for that convenience with higher interest rates or terms that aren't so great.
Okay, we've covered a ton of ground here. Loans, leases, all these different types of financing. So now for the most important part. How do you actually choose the right path for your business? This 5-step framework is your guide.
Think of this as your decision-making blueprint.
All right, this is the 5-step checklist that's going to bring some serious clarity to this choice. First, cash flow. Simple question, but you have to be honest. Can you really afford those monthly payments? Second, total cost. You got to look past that monthly number and see the whole picture, all the interest, all the fees. Third, eligibility. Let's be real for a second. What can you actually get approved for? Fourth, flexibility. What happens if you want to pay the thing off early? Are there going to be penalties? And finally, step 5, and this one's non-negotiable. Talk to your accountant. Seriously, the tax differences between a loan and a lease can be absolutely massive.
So, once you've chosen your path, there's one last hurdle, actually getting approved. So let's pull back the curtain and take a look at what lenders are really looking for in 2026.
First up, the down payment. You've got to be ready to put down somewhere between 10 and 20% of the price. The more skin you have in the game, the better your chances are. Simple as that. It might even get you a lower interest rate.
Next, your credit score. Yep, it still matters. And while there's always a little bit of wiggle room, most lenders are going to want to see a score north of 600. If yours is a little lower, that's when having strong collateral becomes even more important.
But here's the crucial trend for 2026, and you need to hear this. As this quote points out, lenders are becoming absolutely laser-focused on your cash flow. More than almost anything else, they want to see consistent, provable income. It's all about your ability to pay, month in and month out.
So, you want to give yourself the best possible shot at getting a yes? Get these 4 things totally buttoned up. 1. Get your financials organized. 2. Have a clear, simple plan that shows exactly how this new equipment is going to make you money. 3. Show them that your overall debt is under control. And 4. Have those bank statements ready to go. Prove that cash is consistently coming in the door. You know, at the end of the day, navigating this tricky 2026 economy isn't about slamming on the brakes. It's about being strategic. The right piece of equipment, financed the right way, can unlock growth you didn't even think was possible. So the real question isn't if you should invest, it's how you're going to do it smartly. So, what's your next move?